Market news now. The dollar held steady while long-dated U.S. bond yields rose as investors weighed whether an assassination attempt on presidential candidate Donald Trump increased his chances of winning November's U.S. election. Investors have tended to react to the prospect of a Trump win by pushing Treasury yields higher, in part on the assumption his economic policies would add to inflation and debt. Meanwhile, the rand weakened against the dollar as the attempt on Trump dented appetite for riskier assets and spurred safe haven demand. The risk-sensitive rand's fall was in line with moves seen in Asian emerging market currencies. This week's main domestic drivers will come on Thursday, when the Reserve Bank will announce its interest rate decision and President Cyril Ramaphosa will deliver an address to Parliament on his coalition government's priorities. Looking at the markets, All-Share Index down nearly 0.25%, financials up 0.1%, and industrials as well as resources down as well. The rand trading at around 18.16 to the dollar, 19 rand 81 to the euro, and a pound will cost you 23 rand 58. To give us perspective on the markets, we are joined by Roy Mutuni, who's a portfolio manager at Sanlam Investments. Roy, thank you so much for your time. What do you make of market sentiment right now, especially as we try and swirl around this idea of a Trump trade?
Hi, Natasha. Thanks for having me. So markets look a little bit skittish. Remember, we're in the middle of earnings season, and then there's the events over the weekend. And there's also the data that came out last week around inflation. So it's not quite clear. What you saw late last week was a bit of a rotation out of the AI-driven semiconductor stocks into broader value, mid and smaller caps. And I think, to me, that was a reflection of the market beginning to believe that interest rates will start to come down and the growth trade should expand. Clearly, what happened to ex-President Trump has put a little bit of a dampener onto the markets now, because you have to reassess. And I think when you're looking through the next week or so in the US, they'll be talking more about trying to calm things down, trying to gain perspective from what has happened, rather than the standard noise around the presidential election itself.
Let's stick around this expectation around U.S. interest rates, which, markets seem to believe will happen in September. If we do get these rate cuts, do you stick with the big U.S. tech stocks, the ones that have brought in all these gains, or do you start spreading yourself towards the unloved parts of the markets that stand to benefit from rate cuts?
Well, conceptually, I think the way to think of this is that up until now, there's only been one game in town. Because interest rates have been so high, it's been very difficult to find growth in small mid caps or in value. The only real source of growth has been AI-driven semiconductor stocks and tech stocks. And that's why it's really concentrated around those. With interest rates starting to come down, that should give the smaller companies the ability to breathe, the ability to get easier financing for their debt, and start earnings growth there. So I think what it does is it separates investors from the no-growth AI-focused stocks to the now potentially starting to grow non-AI value mid-cap, smaller cap stocks, which widens the breadth of the market and opens up new opportunities. And I think that's what we saw on Friday and potentially also on Thursday last week.
All right, speaking of what we saw on Friday, we had the U.S. banks kicking us off with earnings season. What was the one or two things that stood out for you, and what does it say about some of the banks that are going to be releasing today as well as over the next couple of days?
So there are two dimensions here. The first one was they were all struggling to grow deposits. Why? Because most investors are taking their money out of the banks and investing directly into money market accounts that invest directly into short-term US bills, because these are yielding 4, 5, 6%. That's where you want to be. You don't want to be in a bank. So these banks have had to increase the rates they're offering to get their deposits in. That said, on the lending side, it's been a struggle as well, because interest rates are high, people aren't borrowing, and the ones who borrowed have been defaulting. We started seeing higher credit card balances, greater delinquencies on the credit card side, just showing you that the consumer is struggling. I think this is what you're going to see across reporting season for the banks, that margins are getting squeezed, that credit quality is declining, and there's an increasing expectation that at least if interest rates were cut, if short-term interest rates were to come down relatively aggressively over the next 6 to 12 months, then maybe that cycle could turn and you could see some growth coming out of these. But right now, it is definitely tough times.
Okay, apart from the banks, what else are you going to be paying attention to this earnings season?
Look, it's all about the reflections around inflation and the potential for growth coming through. Remember, as interest rates come down, then that means you have an underpin to earnings, because all of these companies that had borrowed aggressively go into refinance, and that brings earnings up because interest cost comes down. That's what we're going to see. And then also, just to see what the next growth driver is. As interest rates start coming down, we go into a different cycle now. It's not just AI driven. We come back to the real world, to real stocks, and it will be interesting to see what the growth impetus will be there. Broader, you'll have more perspective from a stock picking perspective, and then the U.S. elections. It's quite clear that regardless of who wins, you're still going to have the big budget deficit, the growing debt, and probably high long-term rates. So a very steep curve. So it will be interesting to see what companies are able to benefit from that: low short-term rates, high long-term rates.
Unfortunately, we've run out of time. I would have loved to gather your perspective when it comes to how constructive you are about the South African economy, but we'll leave that conversation for another day. That is where we leave it when it comes to our markets focus. Of course, we are going to be looking out for the Reserve Bank interest rate decision. Markets are expecting the Reserve Bank to leave the interest rate unchanged, given the fact that inflation is still not necessarily where the Reserve Bank would like it. Yet at the same time, we've got the ECB also announcing its interest rate decision. Again, expectations is that it will remain unchanged.